Welcome, everyone. Another great video. We're talking about estate. One of the most misunderstood things, at least that we experience when folks are doing estate planning, is taxes. How do the taxes apply? What happens from a high level? We're going to tackle that right now. Go through some misconceptions, provide a few facts. I think we got to start here, Kevin, with this key question. One we get asked quite frequently: is there an inheritance tax in Canada? So you're the beneficiary. Someone passes away, you get a chunk of change. Do you pay tax on that?
Let's put this in the simplest perspective we can. No. Canada does not have an actual inheritance tax. Now, there are taxes that can be considered similar to what an inheritance, but as a direct inheritance tax, Canada does not have it. This is something that's more strictly U.S. and the North American sort of the marketplace.
That could be the source of the confusion, is the U.S. Now, federally, the U.S. does not actually have an inheritance tax, but some states, in fact, there's 6 states, I'll list them here, 6 states do have an inheritance tax. So maybe that's confusion. Some folks hear about some of the states have an inheritance tax. They think Canada might be following suit. Not the case. If you get an inheritance tax, it's already paid. That cash is yours. You don't have to pay tax on the inheritance. A similar question related, a little more complicated though, is there an estate tax in Canada? So if you have an estate of $1 million, a CRA going to come and say, hey, we want 2% or a certain percent of that. Technically, no, right?
Right. I mean, and that's the biggest question. Technically, we do not have what's known as inheritance tax, and technically, we do not have estate tax. We do not tax a specific amount on your assets. What we do have is more of a final tax return. CRA, not on the assets, but they will tax your income. And that's where the biggest question is going to come in on this whole thing is, what is considered income for you when you die? Does it count just what you have that you've made over the year? Does it count non-registered assets? Does it count your RSPs? Does it count, your TFSAs? Is everything added together, or how's it work? That's the biggest thing. So we do not really have the inherit or the estate tax, they say, but we do have a final tax return on income, and that's where the definitions have to be coming in. And the biggest one to start with is this,
right here, right? You got to introduce this guy, which is the deemed disposition, because again, CRA, we're talking federal level here. They don't tax the assets when you pass away. They do tax income, but the deemed disposition certainly can create more income in that final tax return. So I'll pull this up, a little bit of definition. When you pass away, so whatever that date is, you're deemed to dispose of all your assets. That's how the deemed disposition works. Essentially, from a tax perspective, it's like you sold everything. All your RSPs are collapsed. Your real estate has been sold. Of course, if you have joint ownership or beneficiaries, that could be a little different. But essentially, you no longer own anything. And in that disposition process, you could create some extra income, and that could relate in additional taxes. So they're taxing the income, but the deemed disposition could create extra income that ends up on that final tax return. A quick example there, Kevin, is real estate. I think one everyone can relate to. A little caution, or I guess an exemption is a better word for it, the principal residence exemption. We've done other videos on that, so we'll link to those. You can definitely go through that. But essentially, your own property, tax-free. You don't have to worry about it when you pass away. It's if you have secondary properties, if you have a cottage, you have a rental property, any additional property, when you pass, you're deemed to have disposed of those. And that means it could trigger some capital gains, right? When you sell real estate, hopefully you're selling it for more than you paid for it. And that means that extra gain, you bought it for 100 grand, you sell it for 200 grand, that extra gain becomes taxable, and that could form additional income in your final tax return. Lots more examples that we're going to go through in just a second, but we should mention this can get complicated. People have questions. Where should they go if they have questions, Kevin?
If they have questions on this topic or any of the other ones that we put in our videos or things that come to mind for you, you should go to chatwithclintonandkevin.com. Give us the question. We're more than happy to answer it as best we can and help out with that whole process for you and make sure that you can get the direct answers or go to the places that you need to do it. But as Clint mentioned before, there's more than just the deemed disposition there for the assets that are mentioned for what you have non-registered or what you have for real estate. Your RSPs are there. That's one aspect that you can look at. Now, RSPs, you're deemed to have sold everything. Remember, you've never paid tax on this money. So if you have a large RSP or a LIF, a RIF, a TFSA, or actually a LIF, a RIF, a PRIF, or a LIRA, all in the alphabet soup scenario, you're deemed to have sold that all day then. So if you have a $500,000 sitting in your RIF, that is now considered all income to you now, and you are taxable on that. So the government is going to want their portion of whatever it is. Again, there are rules. If it rolls to a spouse as a named beneficiary, none of those taxes occur. At that point in time, they would occur on her death or his death, depending on what it is. That's the deemed disposition when it occurs. And the big thing to remember is that the estate will pay the taxes on this. Beneficiary receives the funds after the taxes have been paid from the estate. That's a huge one to take a look at going forward.
Yeah. So a quick example there. So if I leave my wife as a beneficiary and I pass away, there is no deemed disposition. It just rolls over to her tax-free. But when she passes, then it's going to get taxed. And it'd be treated as income. So if there's 200 grand left in that RSP, well, that's 200,000 of income, which in most provinces that pushes it pretty high in the tax brackets. It's a pretty big tax bill. So don't die with lots of money in your RSP. That's the take-home message. But finishing the example, or let's say I left my brother as beneficiary, he'd get the money, no inheritance tax, so he has the money without any tax. But my estate would have to pay the tax first, right? It has to claim it as income, pay the tax. Then my brother would get the funds as beneficiary. So key note there, that deemed disposition does pose some issues. You mentioned it earlier. It's not just RSP, but pretty much the whole alphabet soup. You got a LIF, you got a RIF. Any kind of registered account, for the most part, will have this deemed disposition, creating a big tax liability. The exception, Kevin, well, it's in the name, tax-free savings account. So that one's tax-free. We don't have to worry about the TFSA. I'm going to quickly finish here with the new one, the FHSA. This one, the first home savings account. A couple of details here. It's still kind of fleshing out all the legislation, so it could change. But at the moment, if I qualify as a first home buyer, I put money in the FHSA, I name, say, my spouse as a beneficiary, and then I pass away and my spouse qualifies as a first-time home buyer, it can just go into their FHSA. If they don't qualify, well, then when I pass away, I can go into their RRSP, and then those have an RSP going forward. So it's a lot of details there on the deemed disposition, but I think it helps solve some of the problems of that estate tax conundrum. We got to go back to the estate tax from a provincial level, though, Kevin, and we have to introduce probate fees.
Yeah, and probate is definitely a distinction. I mean, if you really want to consider it, maybe it's listed as a tax. It's not really a tax. It's more of a fee that they charge you. So again, if you're talking inheritance tax in the US, they're charging you 2% on your assets. Well, probate's a similar sort of thing. It's a fee that's assessed on the estate's value. And this is not federally regulated, it is provincially regulated. So each province has their own rules and regulations for how they deem this. And again, the big aspect is usually the same scenario. As the estate becomes larger and larger and larger, the fees tend to increase proportionally to the estate's value because they want to take that sort of a value away. So again, it's not really a tax, but it is a fee that you have to pay. So it's similar to an inheritance tax in that way down in the US.
Yeah, and again, the difference here, CRA, so federal level, they're taxing income, and that deemed disposition when you die could result in extra income in which they tax. The probate is provincial, and they are looking at the asset size. So like the tax on 100 grand will be different than the tax on $1 million. So the larger the asset typically, and again, I'm saying tax, it's not actually tax. It's separate from income tax. It's technically a fee. But anyway, it's money leaving the estate and going to the province, and it is based on assets. I found this at advisorsavvy.com. I thought it was actually a pretty good summary. It's a very high level, but gives you kind of 4 key steps that typically happen when someone passes away in Canada. Do you want to walk us through these, Kevin?
Yeah, I mean, the first thing that anybody wants to do is you got to figure out what your income is for the year, because that's where the tax goes. I mean, we're talking final tax return, it's on your income. So you got to get a deemed disposition for everything you have, everything sold, date of death, you get that one. After you've got that, then you can do the final tax return. And remember, final tax return works within a certain range. If you die within the first 10 months of the year, you still have taxes due on April 30th. But if you die in the last 2, they give you 6 months after the date of death. So if you died the middle of December, now you don't have to worry about taxes till the middle of May. So there is a little bit of a time frame there because they do realize that it's a process to get everything done. When you're gone through step 2, you get to probate. Final returns are all done. You must validate that the will is there and it's valid and everything else. You do that through the probate process. Once that's all been completed and verified, then the asset distribution can go. The executor can distribute the assets to the beneficiary and it solves it up. Yes, very high level, very simple. There are probably a few more steps in there that may be taken, but this is the basic scenario for what we want to deal with on the probate when someone passes. Yeah,
and a quick example here, probate, like we talked about, done through the territory, through the province. It does vary depending on where you live, and you can see it can vary quite a bit. So advisorsavvy.com had the details of how probate is calculated in each province and territory. I then ran through an example and did the calculation based on 500 grand. And quick note, Kevin, if you're going to die, apparently Manitoba is the province in which you want to pass away, because in 2020, they got rid of probate fees. Ontario, BC, Nova Scotia, the high end of the scale here. You can see they're charging more on that $500,000 estate. And then all the other provinces and territories are somewhere in between the two. But it very much depends on where you live. And I should mention this, we're talking simplistically here, but it does get complicated if you have assets or property in multiple spots. Let's say you live in Manitoba, you got a cottage in Ontario, or you live in Ontario, you got a cottage in Quebec, whatever the situation is. Once you have more than one province involved, you could end up being charged probate in the province where the asset is located. So if I live in Manitoba and my cottage is in Ontario, the value of that cottage could be probated in Ontario at the Ontario rate. So you do have to keep that in mind. That can be a complicating factor.
Yeah, and that's a big one to be able to deal with. So remember, if you're buying your cabin, you want to do it, don't go Lake of the Woods, don't go to Saskatchewan. If you're a Manitoban, stay in Manitoba. That way you don't have to worry about these probate fees that may occur based on the sale or the probate that has to happen based on the size of the cabin. But yeah, that basically gives us a quick definition and coverage of what's gone on for making sure you know what the tax sort of situation is when a person dies. Again, you can go to chatwithclintonandkevin.com if you have any more questions on this, and we can get more out of it from there. Otherwise, I think we've given you a quick high-level scenario as to what's gone on with probate fees, what's gone on with inheritance tax, what's gone on with estate tax, those that don't apply, final tax return in Canada. Any closing words for anybody else?
We talked probate there. I will mention we do have video specifically on that. We have a video that's probably floating on the screen right now about how probate and joint accounts could work and how joint accounts may be able to help you avoid some probate. Lots of details. So click on that video and we'll see you there. Take care.